This week, we're talking cattle on feed, and we'll preview next week's reports. Welcome to the weekly Livestock Market update on Brownfield. I'm your host, Meghan Grebner. With us this week is University of Tennessee ag economist Charley Martinez, filling in for University of Missouri Scott Brown. Charley, welcome to the show.
Thanks for having me.
Thanks for filling in this week. We're excited to catch up. We'll dig into all of the details of that cattle on feed report that we've all been kind of waiting for this month. But first, let's recap what happened this week in the markets.
Yeah, for sure, Meghan. So looking at the markets, live fed cattle prices were down $2 compared to a week ago. August live cattle were up 73 cents compared to a week ago. And then as we get into the feeder cattle side of things, August feeder cattle were down $3.05, approximately $3 on the week. As we get into the to the box beef side of things, choice box beef was $313.83. So at the end of the week, which is down from $322 compared to last week. And then as we get into the hog side of things, cash hogs were 60 cents higher this week. But one of the more eye-popping numbers compared to last week was August lean hog futures were down, or were actually up $3.12 on the week, which is a pretty good indication and strong signal there. And then that kind of carried over into the pork cutout, where we saw pork cutout values up just over $3.30 this week.
It's nice to see a little bit of demand resiliency, or at least a little bit of some price support on the hog side of things. Charley, as we look at a little bit of pullback on the cattle, are we just at a point where we're hitting record high prices and we've been at these really high, lofty levels that the market's got to take a little bit of a breather, and this shouldn't be alarming at this point?
I would agree. There is some of that. I like the term resiliency in the market as well, in terms of, I think there's still strong demand in the supply chain, but relatively speaking to an annual expectation, this is, what we call the dog days of summer, where we will see some decreases naturally in prices. And so the key indicator, though, is while they are kind of decreasing relative to last week, they're not really momentum swings by any means. And I think that's kind of on par of what we expect in the markets. And so, I think the next couple of weeks will be more of an indicator of, as we get into the dog days of summer, the resiliency of the demand. And, as we get into and later on in the slaughter side of things, we know that there's just a simple function of supply whenever we start thinking about the price discovery standpoint that I think we're starting to hit naturally just because of seasonal trends.
Let's talk a little bit on the slaughter side of things, as we're telling two, I think, different stories right now if we're taking a look at cattle slaughter in comparison to hog slaughter numbers.
Oh, yeah. No, I agree. If we look at weekly slaughter numbers for this week, at the end of the week, cattle slaughter was at 584,000 head, which is down 17,000 on the week. And if you compare that to a year ago, that's actually down 42,000 head compared to last year. That's drastically different as we start looking at the hog side of things, where hog slaughter is up hog slaughter was 2.3 million head, which is actually up 8,000 from the previous week. And up actually 44,000 compared to a year ago. So we have drastic, two sides of the coin there happening in these two protein markets. And so depending upon what producer or what kind of producer you're talking to, it could be bad news or it could be good news, depending upon how you want to look at it. But year to date, cattle slaughter is down 4.5% and hog slaughter is up 1.1%. So I think the story that we're seeing this week is still, a good snapshot of what's happened throughout the year as well.
Charley, big report this week, cattle on feed numbers. And I think the thing for me that stands out, or the thing that we're watching so much and looking for, is what that heifer number is, because we aren't getting that July cattle inventory report from the USDA.
Right. As economists, we like getting those January 1 and July 1 reports. It's always something very intriguing, especially as we start thinking about where we are in a cattle cycle and the lingering question of, are we going to be expanding? Are we still contracting? Are we holding on par? But as we get into that July report that came out, if you look at the report, it said we were up 1% in terms of total cattle on feed at 11.3 million head. But if you run the numbers, it's a little over 0.5%. So it's just, rounded up. So we're still looking relatively on par compared to last year. Prior to the report coming out, there was estimates ranging from anywhere from 1 to 1.25 to 1.3%. So kind of seeing it come in at, if you round up to 1%, or if you take a point estimate of 0.5%, it's still kind of intriguing just to see where we are. The June placements in the feedlots totaled 1.56 million head, which was down 6.8% from a year ago. And the pre-report estimates that we were kind of looking at averaged with the expected placements down to 3%. So, one estimate that, we were overestimating, and then another estimate we were severely underestimating. So it kind of gives indication, especially with this cattle on free feed report, with that question about herd, rebuilding or not, seems to be that we still have placements occurring, at a higher level than some of the estimates we're thinking. June marketings totaled 1.7 million head, down 8.7% from 2023. And again, the pre-report estimates were expecting, to be around 8.2%. So we finally got some estimates kind of on par or on the money there. Placements on feed by weight were kind of intriguing for cattle that were 700 pounds or below. They were down 6.8%. For the 700 to 899 pound range, we were down 6.7%. And the 900 pounds and over, we were actually down 7.5%. So we see across each weight class, us going down compared to a year ago. But that's, relatively expected, right? If we think about what happened last year with so much herd liquidation, fewer cows out there, well, then we'll naturally have fewer calves to be putting into the feed yard. So that's kind of expected. I think that, if you take the accumulation of that report, being, only 0.5% or 1%, however you want to look at it, higher than last year, that's kind of indicative, though, that we're still holding on par to what our herd was relative to last year. So we might see some of the same tendencies. But within that report, the most intriguing thing that we have, since we don't have the July 1 herd estimates for heifers being held as replacements, is the number of females that are in the yards or cattle on feed that are the heifers. And if you look at the report, it relatively was unchanged relative to last year. So for us, if we think about it, we have less animals compared to a year ago to be putting into the yard. So we expect lower placements. But at the same time, we have relatively the same demographic of heifers being in the yard. And so for me, since we don't have the July 1 report, that's an indication that we're probably still not rebuilding at all, or there's no indication of rebuilding nationally right now. Maybe in certain pockets, there might be, thoughts of rebuilding depending upon the regional market that someone's in. But as a national herd, they're signaling that, there really is no herd rebuilding that's currently happening. So that does provide some support for prices into the future as we start thinking about what we can expect as we get into the fall run and into the fall months and into winter. And so, I think, from that report, that's the one big thing that I take away. Estimates were off here and there, but seeing that there was, relatively the same amount of heifers in the yards compared to a year ago, to me, there is no signal or indication that there's any national herd rebuilding. And, as I mentioned, it could be regionally specific. I know in Tennessee, we have some drought that's hitting. And so any thought of people that were wanting to increase their herd or expand their herd, it's kind of, those plans are getting put on hold right now as we're starting to feed hay in not only in Tennessee, but in the Southeast.
It really is interesting when you take a look at that drought monitor map, Charlie. Missouri struggled a year ago. That part of the world was having some challenges in 2023. It was Southeast was a little bit more lush a year ago and even 2 years ago, and it's kind of moved around. When you look at not having that July inventory report, how important is it for you as an economist to have, one, this heifer data that we get quarterly, but two, to kind of help gauge, or where are you looking to see if there's pockets of growth anywhere?
Yeah, so in the daily routine of what I do in extension programming, as we knew that we weren't going to have this July report, I often indicated we could look at the mix or the demographic of heifers on feed throughout the year and kind of keep track of that and monitor that. The July 1 report is much easier and cleaner for us to use as economists, but now it requires us to kind of do some back of the napkin math to kind of monitor And so, we are missing that report. And I think, this year in particular, just because of the question of rebuilding or not, during years of kind of the herd holding steady, the July report sometimes gives us some valuable information, sometimes not when it comes to the female side or the heifer replacement side. But in this year, it was kind of an unlucky year for the report to stop, and so for us, it's it's still important in terms of trying to monitor somehow, some way of what's happening in the market, because at the end of the day, that's what we have to monitor in order to know what can happen into the future in terms of at what point do we hit this. I don't. Some producers call it price asset bubble of, all right, we've hit the limit, and so now we have to start coming down. So for us, that's what we're trying to monitor, and why that report was so important for this year, especially. And so it's one of those deals that, there's ways that we can still monitor it. It's just a matter of different way of thinking compared to what we've done historically.
Charley, as you think about risk management for producers, and as you talk to producers in your area and around the country, I would assume if we're not growing yet, there is potential, as long as demand holds, for this price level to push higher. How much are you talking about risk management?
So risk management has become one of the key things that we talk about, not only in Tennessee and the Southeast, but around the country. One, because, historically 4 or 5 years ago, LRP, for instance, it probably wasn't as user friendly or, price risk friendly for small to medium producers, just because the premium in the payout, they weren't in balance with each other, and it kind of costed producers more than it actually paid out. But now with the subsidies and everything else that's associated with the premium, it makes it more user friendly. And so now we're encouraging producers to look more into an LRP type risk management tool that especially in the small medium sized farms, because if you're monitoring prices and you're expecting prices to go up, well, then at the end of the day, you still need to secure some type of profit. And if it goes over the top, I mean, that's just gravy on top for you at the spot market, right? So the more you can, set a price floor, with an LRP or some type of other risk management tool like a futures or an option, that does allow you to have some top side potential while still securing, a relatively high floor. And I think about it last year. I've often talk about this year is resembling a lot what happened last year. And so as we get these reports, they are holding on par. But if we go back to around this time last year, an October LRP or a November LRP insurance policy, it didn't look too enticing, just because people were like, no, prices are going to go up. Why would I want to pay money in order to secure that insurance policy when prices, they can't go down? There's no way they can go down. Well, if you remember back in October, November, what happened to feeder calf prices, for instance, they all tanked. And so folks that didn't have insurance policies, they had to take the spot market or the cash market. They weren't too happy. Was it still profitable? Probably. But they left more money on the table because they weren't taking out insurance policies, or they hadn't locked in those prices. And so I think, right now it's, if you're a producer that is thinking about prices and you're still bullish on the prices for the fall, that's great. But I think how do you secure a downside or a floor of that price that you're anticipating? I don't think that's a bad strategy, especially given that the cost of it is relatively not as expensive as it historically has been. And then also, if you think about that cost of not insuring that policy, as we saw last year, it paled in comparison to the money that someone didn't get because they took the cash market or the spot market, wherever they were marketing their animals, and they saw that downside price that at the end of the day was worse off than having that insurance policy and paying that extra cost to have that insurance policy. And so this year, we're encouraging people to look more into the LRP especially, but other tools as we get into kind of uncertain territory, especially with drought in certain areas. And then as we start thinking about what happened last year when we saw the downside turn late October, early November.
Charley, that's the only report we have this week. It's an easy week to step in and to pinch it, and I appreciate it. As we look ahead to next week, obviously cold storage numbers come out, livestock slaughter comes out. As you take a look at that and those reports, what are you watching for, and what are you maybe looking for there?
Yeah, no. So I knew you mentioned that it was a easy week, quote unquote, to step in, and I don't think Scott has to worry about getting Wally pipped at all. But as we start talking about next week's report, whether it's cold storage or livestock slaughter, I think for me the one that I want to watch and that I think I'm going to be more intrigued by is the livestock slaughter. Just because if on the cattle side of things, we are getting into the dog days of summer. We know that historically we're going to trend down as we get through August and September before they start ramping up for the fall. The Packers, and so on that side, I want to see just how much we're being pulled back compared to a year ago. I think that's going to be something to watch. From the beef cattle side, the hog slaughter side of things. I think it's going to be more of just kind of monitoring and the positivity moving forward. Cold storage. I know a couple of weeks ago there was a Southern Ag Today article that talked about cold storage kind of going down in terms of total volume that was in there, and so it'll be something just to monitor to see if it's picked up or holding steady or decreasing. But for me, livestock slaughter is going to be the one that I'll be the most intrigued by.
And obviously seeing what's going on with those beef cow slaughter numbers as well.
Yeah, no, it's the most interesting thing has been watching the cold cow side of things. The prices have been holding steady. We've been encouraging folks, if you got some cow that's open or a bull that's not getting his job done, the price has been holding steady. And so not only, that side of things, seeing the slaughter numbers, but that's also indicative as to what prices will be moving forward as well.
Charley, thank you so much for filling in this week and joining us. We appreciate it.
Awesome. Thank you, Megan.
We have our weekly livestock market update delivered to your email box every Saturday morning. Go to brownfieldagnews.com. You can also submit questions and comments. And for a rundown of what happens every day in the commodity markets, make sure to check out John Perkins' Market Minute. Have a great weekend. I'm Meghan Grebner for Brownfield.